Citi just crossed a line that Wall Street spent years pretending it would never cross. One of the biggest banks on earth is preparing to custody Bitcoin in 2026, not through a side app, not through some experimental startup partnership hidden in the background, inside the banking system itself. And if you think this is just another crypto headline, you are missing what may be the biggest structural shift in Bitcoin's history. Because this is not about one bank adding one product. This is about the old financial system finally admitting that Bitcoin is not going away. And once a bank of this size starts building custody, reporting, settlement, and client access around Bitcoin, the conversation changes completely. Bitcoin stops looking like an outsider asset that lives on exchanges and hardware wallets. It starts looking like something the largest institutions in the world are willing to place beside stocks, bonds, and cash. That changes everything. Because for years, the biggest barrier to Bitcoin was not belief. It was friction. It was fear. It was complexity. Wallets, seed phrases, transfers, security risk, compliance headaches, operational risk. Institutions looked at Bitcoin and saw demand, but they also saw a mess. A powerful asset trapped inside infrastructure that traditional finance could not comfortably touch. Now Citi is telling that world, we will touch it for you. And that is why this moment matters so much. Because once Bitcoin can sit inside the same institutional framework as securities and money, the walls separating crypto from traditional finance start collapsing. Slowly at first, then all at once. What happened is simple. Citi announced that it is launching institutional Bitcoin custody later this year, and Morgan Stanley is pushing deeper into spot crypto trading, digital asset products, wallet infrastructure, and even Bitcoin-linked lending ideas. Two financial giants, two different angles, one message. The handshake between traditional finance and Bitcoin is no longer theoretical. It is happening. And that handshake is not symbolic. It is operational. That is the real story here. Not hype, not slogans. Infrastructure. Because infrastructure is what turns an idea into a permanent part of the system. For more than a decade, Bitcoin lived in a parallel universe. If you wanted exposure, you usually had to step outside the normal banking rails. You went to a crypto exchange. You learned a new interface. You dealt with new risks. You either trusted yourself to secure the asset or trusted a crypto-native platform to do it for you. Traditional finance stayed close enough to watch, but far enough to deny responsibility. That model is breaking, and Citi's move makes that impossible to ignore. This is not some small bank chasing headlines. Citi sits near the center of global financial plumbing. When a bank that moves money for governments, large corporations, hedge funds, and institutional clients decides Bitcoin deserves formal custody infrastructure, it tells you something profound. The market has moved beyond the question of whether Bitcoin is real. The new question is, who will control access to it? That is a much bigger battle. So let's strip this down to the core. What is custody? In plain English, custody means the institution holds the asset on behalf of the client. It secures it, reports it, accounts for it, integrates it into the broader financial relationship. In traditional markets, this is normal. Most investors do not personally hold the plumbing behind their stocks or bonds. Institutions do that work. The system abstracts the complexity away. Bitcoin never fit neatly into that framework, until now. And that is the revolution hidden inside this announcement. Citi is not merely saying, we like Bitcoin. Citi is saying, we are building the architecture to treat Bitcoin like a legitimate financial asset inside a regulated institutional environment. That is a completely different level of commitment. Because once you build custody, you are not just speculating on price. You are betting on permanence. And the really important part is not the headline itself. It is the model behind it. Citi's vision is bigger than a vault for digital coins. The vision is one service model across crypto, securities, and money. One account logic, one reporting logic, one operational layer, one institution managing assets that used to live in separate worlds. That means a future where Bitcoin does not sit in a weird crypto silo. It sits alongside treasury bonds, funds, cash positions, and other assets that large clients already manage through conventional financial channels. Do you see what just happened? Bitcoin did not just get a product. It got invited into the house. And once that happens, the psychology changes for institutional capital. Because the institutional client that was uncomfortable with wallets, private keys, blockchain transaction handling, and crypto-specific operations suddenly hears a different message. You do not need to become a crypto expert. You do not need to train your team on wallet security. You do not need to build an entirely new operational process. The bank will do it. The reporting will be familiar. The access will be familiar. The relationship will be familiar. That removes friction. And friction is what kept enormous pools of money on the sidelines. Now think one step further. Once custody exists inside a large financial institution, Bitcoin becomes easier to integrate into collateral frameworks, portfolio reporting, risk systems, and cross-asset management. That is where this story gets really big. Because Bitcoin is no longer just something you buy. It becomes something the financial system can work with. That is a dangerous sentence if you still think this is a niche market. Because when an asset becomes operationally useful, not just ideologically interesting, demand changes shape. It becomes stickier, more structural, more deeply embedded. This is why Citi's move matters even beyond the people who will actually use Citi custody. The existence of the rail changes the perception of the asset. And at the same time, Morgan Stanley is attacking the same opportunity from another side of the battlefield. If Citi is making Bitcoin bankable for institutions, Morgan Stanley is making crypto harder for mainstream wealth clients to ignore. That matters because Morgan Stanley does not serve a tiny experimental audience. It sits in front of trillions in client assets. The firm's influence reaches into the portfolios, advisors, accounts, and financial decisions of people who are wealthy, curious, and cautious. That combination is powerful. Curious enough to want exposure, cautious enough to wait for a trusted door. Morgan Stanley is trying to become that door. And this is where the story stops being about crypto enthusiasts and starts becoming about distribution. Bitcoin has always had believers. What it lacked was frictionless, familiar distribution inside the traditional wealth machine. If Morgan Stanley expands crypto access through normal financial channels, it is not just offering a product. It is reducing psychological resistance for an enormous class of clients who never wanted to touch the old crypto user experience. That is huge. Because adoption is not just about wanting the asset, it is about the path by which the asset reaches the buyer. ETF access, spot trading access, wallet integration, potential lending and yield products, portfolio visibility through the same wealth relationship. These are not random features. They are pieces of a larger institutional strategy. The strategy is to domesticate crypto for the traditional investor, to make it feel less like a separate universe and more like another tab inside a familiar financial life. That is how mass access happens. Not when everyone becomes technically sophisticated, but when the system removes the need for them to be. And if you are wondering why all of this is accelerating in 2026, the answer is brutally simple. Demand finally reached the point where the banks could no longer justify waiting. Institutional clients want exposure without the operational nightmare. Wealth clients want access without the self-custody burden. Banks see the fees, the market share, the strategic advantage, and the long-term importance of owning the rails. So now they are moving. And when banks move, they do not move because of excitement. They move because they have done the math. That math is not just about custody fees or trading fees. It is about controlling the next generation of market infrastructure. Because Bitcoin is not entering the traditional system alone, it is arriving alongside a broader transformation in how markets themselves are being rebuilt. Tokenization, around-the-clock settlement, digital asset integration, the slow death of the old market hours mentality. The idea that finance should close on weekends is starting to look old in a world where digital assets never sleep. This is where the story becomes much bigger than Bitcoin custody, because the same forces pushing banks into crypto are also pushing the rest of finance toward a 24/7 architecture. Once clients get used to assets that trade around the clock, expectations change. Once digital settlement becomes more normal, old frictions start looking inefficient. Once tokenized instruments begin appearing inside mainstream channels, the line between traditional and crypto native starts to blur. And when that line blurs, the winners will be the institutions that built early, not the ones that hesitated. That is why Morgan Stanley's internal build philosophy matters so much. Building internally instead of simply renting someone else's crypto stack is a declaration. It says this is not a temporary experiment. It says the institution wants ownership, control, deep integration, and long-term advantage. It says crypto is not a side feature. It is becoming part of the strategic core. That is a very serious signal. Because giant financial institutions do not spend time and money internalizing capabilities unless they believe those capabilities will matter for years. So step back and look at the full picture. Citi is building custody and integrated service rails. Morgan Stanley is building access, exposure, and wealth channel distribution. Both are reducing friction. Both are normalizing Bitcoin. Both are making it easier for traditional capital to enter the asset class through trusted names. And once that starts happening at scale, the market is not playing the same game anymore. Now, there is a deeper tension here, and it matters. Bitcoin was born as something outside the banking system. For many people, that was the point. No intermediary, no gatekeeper, no institution between you and your money. So what happens when the exact institutions Bitcoin was designed to route around begin offering custody, access, and portfolio integration? Some people will call that corruption. Others will call it victory. Both views contain truth. Because yes, institutional custody is not the same thing as self-custody. If your Bitcoin sits inside a bank account, then a bank sits between you and the asset. That changes the relationship. But it is also true that institutional access expands the universe of people and entities that can realistically hold Bitcoin. Pension funds, wealth management clients, institutions with compliance departments, clients who will never use a hardware wallet, capital that was never going to self-custody in the first place. This is why the moment is so important. Bitcoin is not being replaced. It is being absorbed into multiple access models at once. The self-custody path still exists. The institutional path is now being industrialized. And the combination of those two realities is powerful, because it means Bitcoin can remain what it is technically, while expanding the range of people who can participate in it financially. That is how an asset class matures, not by keeping one doorway, but by opening many. Now let's talk about the psychology of what comes next. For years, institutional adoption was treated like a future catalyst, almost like a prophecy people repeated because it sounded bullish. But the phrase was vague. It usually meant institutions buying exposure. That was only phase 1. What is happening now is phase 2. Institutions are not just buying, they are building custody, trading, wallet infrastructure, lending concepts, integration layers, service models, reporting standards, operational rails. That is far more important than one-time buying. Because buying can slow down. Infrastructure changes the game permanently. Once the pipes are in place, flows can expand later. That is what long-term investors should be paying attention to, not just price candles. Pipes. Because once the pipes exist, more capital can move through them. This does not mean nothing can go wrong. Regulation can shift. Execution can disappoint. Client uptake can be slower than expected. Market cycles can still be brutal. Banks can overpromise and underdeliver. Those risks are real. But there is one thing this wave of announcements makes very difficult to deny. The major financial institutions are no longer treating Bitcoin like a temporary curiosity. They are treating it like infrastructure-worthy territory. That is a milestone. And if you still think this is only about crypto people, you are thinking too small. This is about the broader transformation of market access. The same institutions building crypto rails today may be the ones shaping how tokenized securities, digital cash systems, around-the-clock settlement, and integrated multi-asset accounts function tomorrow. The real prize is not just Bitcoin fees. The real prize is controlling the user relationship inside a financial world that is becoming more digital, more continuous, and more interconnected. That is why the battle is accelerating now. Nobody wants to be late to the new rails. And once one major institution commits, pressure builds on the others. Because no large bank wants to explain to clients why a competitor can offer integrated digital asset exposure while they still cannot. No wealth platform wants to watch assets migrate because it failed to evolve. No institution wants to wake up and realize the future of market access was built by someone else. So the race intensifies. And this is where the implications for Bitcoin become fascinating. More access can mean more liquidity, more legitimacy, more capital, more integration into global finance. It can also mean more institutional influence over how most people encounter the asset. Bitcoin may remain decentralized at the protocol level, while becoming increasingly centralized at the access layer for millions of users. That tension will define the next phase. Not whether Bitcoin survives, but how people choose to hold it, use it, and trust it. If you are a self-custody purist, this era will make you more convinced that holding your own keys matters. If you are a traditional investor, this era will make Bitcoin finally look reachable. If you are an institution, this era makes inaction look dangerous. And if you are watching the market as a whole, this era tells you something even bigger. Crypto is no longer waiting outside the gates of traditional finance. The gates are opening from the inside. That is why 2026 may end up being remembered very differently from the years that came before it. Not because Bitcoin suddenly appeared, not because banks discovered crypto overnight, but because this may be the year the traditional financial system stopped resisting structural integration and started building for it openly. That is a major difference. Resistance delays, building commits. And once Citi and Morgan Stanley are both building from their respective angles, the signal becomes hard to miss. The biggest institutions in finance are no longer asking whether digital assets belong in the system. They are asking how fast they can make those assets usable within it. That is the pivot. And the people who understand the difference early will see the market more clearly than the people still stuck in old narratives. So ask yourself this. If one of the world's most powerful banks is preparing to custody Bitcoin, and one of the largest wealth platforms in the world is preparing to expand crypto access across trading, products, and client infrastructure, are we still in the era where Bitcoin has to prove it belongs? Or are we entering the era where the financial system is competing to own the relationship around it? That is the real question now, and it is much bigger than one headline. Because if Bitcoin becomes easier to hold, easier to report, easier to integrate, easier to borrow against, and easier to access inside mainstream finance, then the next adoption wave may not look like the old one at all. It may not begin on crypto exchanges. It may begin inside bank accounts, advisory platforms, wealth portals, and institutional systems that millions of people already trust. That is how revolutions go mainstream. Quietly at first, then suddenly everyone acts like it was obvious. Citi custody is not the end of the story. It is the opening bell for a much bigger shift. Morgan Stanley is not the side note. It is proof that this shift is spreading across multiple layers of the financial machine. The products are coming, the rails are being built, the walls are coming down. And the gap between traditional finance and crypto is shrinking faster than most people realize. Watch the custody story. Watch the trading story. Watch the infrastructure story, because that is where the next phase will be decided. And if you think this changes nothing, look again. The question is no longer whether Bitcoin can survive outside the system. The new question is how deeply the system is about to wrap itself around Bitcoin. That answer could define the next decade of finance. Do you think bank custody will bring a massive new wave of Bitcoin adoption, or do you think it weakens Bitcoin's original promise? And if mainstream investors can buy, hold, and even borrow against Bitcoin from the same platforms they already use for stocks and bonds, what happens to the line between crypto and traditional finance? Subscribe now if you want more deep dive analysis like this. And if this breakdown helped you see the bigger picture, drop your view in the comments, because 2026 is shaping up to be the year the old system stopped fighting Bitcoin and started building around it.